Exchange-traded notes, or ETNs, are structurally similar to exchange-traded funds, or ETFs, but there are some important differences. For investors interested in learning more about this type of investment, it's critical to understand how it differs from index investing and ETFs. A senior unsecured debt product issued by a bank that monitors an underlying index of securities traded on a major exchange similar to a stock. An exchange-traded fund, on the other hand, is a type of investment that follows an index, sector, commodity, or other asset and can be purchased or sold on a stock market in the same way that a regular stock can. Hey, welcome to Stock Market Mate. In this video, we will discuss the similarities and differences between ETNs and ETFs, as well as what you should know before investing in ETNs. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. ETNs versus ETFs. ETNs are structured products that are issued as senior debt notes, whereas ETFs are investments in underlying commodities. In that they are unsecured, ETNs are similar to bonds. ETFs allow investors to invest in a fund that owns the assets they're tracking, such as stocks, bonds, or gold. An ETF is comparable to a mutual fund, but an ETN is comparable to a corporate bond. However, unlike corporate bonds, which have fixed interest rates, ETN returns are determined by the market performance of the tracking index or benchmark. Barclays Bank plc, a 300-year-old financial firm with hundreds of millions of dollars in assets and a strong credit rating from Standard & Poor's, backs its ETNs reasonably consistently. Even with this level of credibility, however, the investments are not without credit risk. Regardless of its reputation, Barclays can never be as safe as a central bank, as seen by the failure of big banks such as Lehman Brothers and Bear Stearns during the recent financial crisis. Even stricter regulations requiring higher safety capital do not totally protect banks from failure. Similarities between ETNs and ETFs. ETFs and ETNs share a few characteristics. To begin with, they both trade in major markets in the same way as stocks do. Second, they're intended to track the underlying assets. Third, their expense ratios are lower than those of actively managed mutual funds. Finally, they can be purchased on margin and through standard brokerage accounts. Differences between ETNs and ETFs. Characteristic traits. However, ETNs differ from ETFs in a few areas. The first distinction is in their distinguishing characteristics. ETNs, like bonds, can be held to maturity or bought and sold at any time, and if the underwriter goes bankrupt, the investor faces a total default. ETFs, on the other hand, are a basket of securities that trade on an exchange, similar to stocks. They can be built to track anything from the price of a single commodity to a big and diverse collection of securities. Risking and tracking errors. Furthermore, the risks in tracking faults of ETNs and ETFs differ significantly. ETNs are exposed to market risk as well as the credit risk of the investment bank that issued the ETN. So if Barclays goes bankrupt, investors may have to wait in line behind larger creditors and may not receive the guaranteed return. ETFs, on the other hand, are only exposed to market risk. The ETN's price closely reflects the index, however, tracking errors can occur if the issuer has credit concerns. Investors will see some divergence from the index they monitor due to fees, causing the fund to underperform the index over time. Liquidity. Trading activity for ETNs can be modest or change substantially, resulting in a large loss or gain for investors who sell an ETN before maturity. ETFs are substantially more liquid. In comparison, the SPDR or S&P 500 SPY ETF has an average daily volume of nearly 168 million shares. Tax treatment. One of the most attractive advantages of ETNs is the possibility to avoid short-term capital gains tax. When an investor sells an ETN, he or she is subject to a long-term capital gains tax, as is the case with traditional ETFs. Each year, a long-term holder would be subject to capital gains tax. ETFs pay dividends or interest rates that are taxed on short-term capital gains. Which is better? Which one should you choose now that you understand the distinctions between ETNs and ETFs? Your tax bracket and investment time horizon will influence this to some extent. While the most significant advantage of an ETN is that the full gain is taxed as a capital gain, this gain is also delayed until the security is sold or matures. This is something that tax-aware long-term investors should not overlook. Capital gains and losses are realized with an ETF as each futures contract is rolled into another. In many cases, ETFs may be preferable to ETNs. It all boils down to risk tolerance and the type of investor you are. ETFs may be preferable if you've met them before. ETFs are a popular type of security among both seasoned and inexperienced investors. ETFs are probably more familiar to you than ETNs, which were created only in 2006. You appreciate the variety of options. ETFs are available from practically every online broker, and there are many more ETFs than ETNs, providing with you plenty of options. You don't mind paying taxes. Some ETFs pay dividends, which are recurring payments sent to you as an investment. However, those dividends are taxed. ETNs may be preferable if you must gain exposure in a specific field. ETNs can be useful if you're looking for a market niche that isn't covered by ETFs. You wish to postpone paying taxes. ETNs are not taxed until the security matures or is sold. Holding an ETN allows you to delay taxes, and if you hold it for more than a year, you'll benefit from long-term capital gains. You don't mind going out of your way to find them. Although there are hundreds of ETFs, only a few hundred ETNs are currently traded. You're willing to accept the additional risk. ETNs are exposed to market risk as well as the issuer's credit risk, which means you could lose your investment if the bank defaults. You can check a bank's credit rating before purchasing, but investing in ETNs comes with an additional risk. The bottom line. The main distinction between ETNs and ETFs is credit risk and tax treatment. While the value of active management is debatable, there is no denying the value that financial engineering has brought to financial markets since deregulation began in the early 1970s. Financial engineering has increased the liquidity and efficiency of our markets. The evolution of the ETN is something that all investors should be aware of and consider adding to their portfolios. ETNs you need to watch for. Conduct due diligence and extensively study investment research before making any investment. One place to begin is by monitoring the performance of ETNs. Here are a few ETNs to keep an eye on. DJP, iPath Bloomberg Commodity Index Total Return ETF. EROTF, iPath EUR or USD Exchange Rate ETN. EMLBF, iPath Long Enhanced MCI Emerging Markets Index ETN. Before making any trades, make sure you properly research each note. Keep an eye on how they react to changing market conditions. Understand the contents of each note, as well as the underlying index or benchmark. This is especially crucial when trading leveraged and inverse ETNs, which generally contains derivatives. If you have any questions or concerns about an ETN, you should speak with a financial professional such as a broker, financial advisor, or financial planner. Key takeaways. Here are a few key points from this video. ETNs are unsecured debt securities that mirror a securities index. ETNs are not the same as ETFs, which monitor an underlying index of securities but trade like stocks. ETNs introduce credit risk that ETFs do not, whereas ETFs introduce tracking risk. ETNs have a better tax treatment than ETFs since they are taxed at the long-term capital gains rate, which is lower than that of ETFs. ETNs are a peripheral holding for most investors due to the default risk inherent in them. Building a full portfolio of ETNs can be quite dangerous. However, ETNs are fantastic investment alternatives for diversifying your portfolio. ETNs are the same as ETFs. While their names are similar, their distinctions are significant. An ETN is an unsecured debt product that obtains exposure through the use of derivatives while demanding exorbitant fees. An ETN investors could lose their entire investment depending simply on the issuer's creditworthiness. ETFs, on the other hand, offer fully supported pooled assets with costs as low as 3 basis points, and an investor's return is determined by how well the fund's equities or bonds perform, not by whether the corporation behind the fund has a credit event. Investors should conduct due diligence not only when selecting specific funds, but also when analyzing investment structures to ensure they grasp both the possible rewards and the hazards. Examine the fund documentation for complete information and be sure to speak with a local sales team member who can assist you with any concerns you may have. Well, that's about it for today. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. Don't forget to hit the notification bell to get our latest updates and new content. We love hearing from you. Thank you for watching, and we'll see you in the next new video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!